Payment on account. If the taxpayer had an income tax liability in the previous tax year in excess of any tax deducted at source, then payment on account is normally required for the following year. No payment on accounts are ever required for capital gain tax or class 2 NIC contribution. It means the payment on account is required for income tax and class NIC 4 contribution. Remember, if the taxpayer has income tax liability in the previous tax year is greater than the pay as you earn amount, then payment on account is required for the following year, and the payment on account is required for class 4 NIC contribution and income tax, not for capital gain tax or class 2 NIC contribution. There are two payments on account required, first on 31st January and second on 31st July. How to calculate the payments on account? These are calculated using the previous year's relevant amount. Therefore, the payments on account for the tax year 21-22 are based on the relevant amount of tax year 2021. And how to calculate the relevant amount? It means total tax liability less pay as you earn. And for the calculation of relevant amount, the total tax liability means income tax and class 4 NIC contribution. Only income tax and class 4 NIC contribution means total tax liability, and from this total tax liability you have to deduct pay as earn to get the amount of relevant amount. Exceptions to payment on account: in case the total tax liability less pay as you earn for the previous tax year is less than 1000. Like for example, the previous year's total tax liability is 10,000 and previous year's total tax liability is 10,000 and tax deducted at source, or you can say pay as you earn, is 9100. It means less than 1000 amount is payable, so there is no payment on account required where the total tax liability less pay as you earn is less than 1000. So in that case, no payment on account is required. Or in second case, you can consider that the amount 9100 is 91% of 10,000. If you consider how much amount you have paid as pay as you earn in terms of percentage, it is 91% of the previous year total tax liability. And the rule is, if the pay as you earn is more than 80% of total tax liability, if the pay as you earn is more than 80% of total tax liability, then again there is no need to pay payments on account. For example, Roderick is required to make payments on account of his tax liability for the tax year 21-22. His income tax liability for the tax year 2021 was 5100. Of this, 1250 was collected through pay as you earn system. Calculate the Roderick's payments on account for the tax year. Remember, for the calculation of payments on account, you need to calculate relevant amount. And what is relevant amount? This is said to be total tax liability, which was 5100 for the previous year, less pay as you earn, and that is 1250. The remaining amount 3850 would be your payments on account, your relevant amount. Now you need to pay these amount in two different dates, on 31st January and on 31st July. And the equal installment would be paid of 1925 in each installment of payments on account. one thing more you need to consider, that the remaining figure, this remaining figure is greater than 1000. Second, the amount pay as you earn, 1250, it is less than 80% of that amount. It is approximately 24% of previous year tax liability. So less than 80%. So that is why payments on account is required. Remember that 2 points we have considered earlier, that in 2 cases there is no need of payments on account. First is that if the total tax liability less pay as you earn, the difference of these two amounts is less than 1000, there is no requirement of payments on account. Second, if the amount paid as tax under the scheme of pay as you earn is 80% or more than the total tax liability, then also there is no need to pay payments on account. In this MCQ, Abdul's tax liability for the tax year 21-22 and 2021 and 21-22 are as follows. What payment on account will Abdul have to make on 31st July 22 in respect of this tax liability for the tax year 21-22? Remember, this is the question to judge your knowledge of exception. This rule has been tested here. If your difference of total tax liability and pay as you earn is less than 1000, then there is no need to pay anything under payments on account. In this case, you need to consider the previous year's income tax is 300 and previous year's class 4 NSE contribution is 320. In total, this amount is 620, which is less than 1000. There is no amount paid under pay as you earn system, but 620 minus 0, total tax liability minus pay as you earn, this is equal to 620, and 620 is less than 1000, so there is no payments on account required, and on 31st July 22 no amount of tax liability is payable. Payment on account. In case of payment on account, sometime if you consider that your current year tax liability is less than previous year tax liability, you can claim to reduce the payments on account. A taxpayer can claim to reduce payments on account at any time before 31st January following the tax year if he expects that the actual income tax and class 4 NIC liability for the tax year 21-22 to be lower than the tax year 2021. So in simple word, if you expect that your current year tax liability of income tax and class 4 NIC contribution is less than previous year tax liability, then you can claim to reduce your payment on account. And what if the claim is incorrect? Your actual tax liability for the current year turns out to be higher than the reduced payments on account. So in that case, interest will be charged on the tax underpaid. Interest on incorrect claims to reduce payment on account. Interest is charged where an excessive claim is made to reduce payments on account. At what amount interest would be charged? Interest would be charged on the difference between the amount actually paid and amount that should have been paid. Difference between amount actually paid and amount that should have been paid. If you have to pay 5,000 and you have paid 3,000, the difference of 2,000 would be the amount on which interest is charged. The amount that should have been paid can be calculated as lower of the original payment on account based on relevant amount for the previous tax year and 50% of final tax liability excluding CGT class 2 NIC for the current tax year. So you need to consider what is the original payment on account, and second, what is the 50% of final tax liability. The lower of these two figures would be considered as amount that should have been paid. Amount that should have been paid. And this amount that should have been paid, then compare with the amount actually paid, and the difference of these two amounts would be considered on which interest would be charged. For example, a taxpayer's relevant amount for the tax year is 5,000. Payment on accounts are therefore half of this, 2,500. But a claim is made to reduce the payment on account to 1,000. Right? Now these payments are made on time. The dates of these are 31st January and 31st July. These have been made on time. Subsequently, the taxpayer calculates the actual tax liability for the year as 4,500. Right? So what we need to consider, on what amount the interest would be charged. First, we need to consider that the balancing payment is 4,500 minus 2,000 is equal to 2,500. It can be said that in two installment, 1,000 plus 1,000, total amount that has been paid is 2,000, and from final tax liability, if this amount is deducted, then you will get the balancing payment, and that is 2,500. And it is paid on 31st January 23. Now question is, identify the amount on which interest will be charged and state the period for which interest will be charged. So first of all, we need to consider what is the amount that should have been paid. Amount that should have been paid is said to be 2,500, the payment on account on the base of original relevant amount, and 2,250. What is 2,250? 50% of final tax liability. Whichever is lower is amount that should have been paid, and that is 2,250. This is the amount that should have been paid. Now we need to compare this with the amount that we have paid actually, and that is 1,000. So this is the difference of 1,250 on which interest is charged. So first, the final payment is made on 31st January 23. First payment on account is on 31st January 22. So from 31st January 22 to 31st January 23, the period of 1 year for which interest would be charged on the first payment on account. This would be 1,250, difference of amount that should have been paid and amount actually paid, multiplied by 2.6% the interest rate of the current year, and as it is for the whole year, this would be the amount of interest charged on the first payment on account. The second payment on account, date of second payment on account is 31st July 22. Actually, tax is paid on 31st January 23. So this is the period of 6 months for which interest should be charged for the period of 6 months. EVA's income tax liability and class 4 NIC contribution for the tax year 21-22 are 4,840. Her income tax liability and class 4 for the tax year 2021 were 6,360. So in that case, the previous year's tax liability is greater than the current year tax liability. Now question is, what is the lowest amount to which EVA could make a claim to reduce each of her payments on account for the tax year 21-22 without being charged interest? So the lower amount of tax, 4,840, would be considered, and half of this would be 2,420, for which is the said to be a lowest amount that could be claimed to reduce each of her payments on account. Based on her income tax liability of 15,600 for the tax year 2021, Sara was liable to make two payments on account for the tax year 21-22 of 7,800 each. So So it's her tax liability is 15,600. She has to make two payments on account, each of 7,800. Now in May 22, Sarah made a claim to reduce her second payment on account to 6,000. This reduced payment was made on 30th September 22. First, she has claimed to reduce the payment on account, but that amount should have been paid on 31st July 22 and she has made actual payment on 30th September 22. Sarah's actual income tax liability for the tax year 21-22 was 16,000, greater than expected income tax liability, and she paid the full balance outstanding on 31st January 23. Whatever amount she has to pay, she paid on 31st January 23. How much interest is payable by Sarah to HMRC in respect of her second payment on account for the tax year 21-22? First, we need to consider here she has to pay her second payment on account on 31st July 22. But up to 30th September 22, she paid nothing. For this period, she has to pay interest on the whole amount of 7,800, 2.6% interest for the 2 months period. Then on 30th September, she paid 6,000. In fact, she has to pay 7,800. It means she pays 1,800 less than the actual amount that she should have been paid. Now on this 1,800 from 30th September to 31st January 23, the date of her making final payment, interest would be charged for the period of 4 months. So this is the total interest that would be charged on her. First, from 31st July, which is the date of second payment of account, to 30th September 22, when she actually paid second payment on account, she has paid nothing. So on this period, 7,800 amount interest would be charged for the period of 2 months. Then she paid 6,000. She has to pay 7,800. She paid 6,000. It means 1,800 less amount has been paid by her. So on this 1,800 for the period from 30th September to 31st January, interest would be charged. This would be 33.8 and 15.6. Approximately this would be 49.4. Now we need to consider about the balancing payment. The balancing payment is due on 31st January following the tax year. Again, for the tax year 21-22, the balancing payment date is 31st January 23. How to calculate the balancing payment? The balancing payment is calculated as total tax liability, and here total tax liability means income tax, class 2 and 4 NSE contribution and capital gain tax, all tax liabilities included. So for the calculation of relevant amount, we means total tax liability as income tax and class 4 NSE contribution. But for the calculation of balancing payment, total tax liability means income tax, class 2 and class 4 NSE contribution and capital gain, less pay as you earn and less payment on account. The balancing payment is due on 31st January following the tax year. It is possible that the balancing repayment will be due, in which case HMRC will repay the amount of tax overpaid. So like in this question, Garrett tax payable for the 2021 and 21-22 is as follows. The important statement is he always pays the correct amount of tax on each due date. What is the amount payable by him to HMRC on 31st January 23 in respect of tax year 21-22? So first we need to consider for income tax, out of 12,500 he has paid 10,000, so remaining amount would be 2500. For class 4 NAC contribution, 2500 less 2000, the amount he has to pay is 500. This is 3000, and now we need to consider the class 2 NAC contribution, which is 159, and capital gain tax liability, which is 2000, and the whole amount would be 5159. That is the amount that is payable on 31st January 23. Continuing the example of Roderick from above, you now learn that his final tax liability for the tax year 21-22 is 7,629. Of this amount, 1635 has been collected through pay-as-you-earn system. State the amount, total amount payable on 31st January 23. So on 31st January 23, he has to pay the second payment on account, as well as he has to pay the balancing payment, and both of this we need to calculate. The payment made on 31st January will comprise of two parts. First, the balancing payment for the tax year 21-22, and the first payment on account of the tax year 22-23. How to calculate the balancing payment for the tax year 2021? That is based on the final liability of the tax year 21-22 less pay as you earn and payment on account already made. So if we calculate the balancing amount, it would be 7629 minus 1635, that is said to be the amount calculated under pay as you earn system, and the payments on account as given in the previous illustration 3850, previous part of this illustration, and it will give you an amount of the balancing payment would be 2144. And what will the payments on account? For the calculation of payments on account, 7629 minus 1635 pay as you earn, and it will give you an amount of 5994. So first, the payment made on 31st January will comprise of two amounts: balancing payment, that is 2144, and the relevant amount is 5994, and half of this would be the payment on account, and that would be 2997, and sum of these two figures would be considered as your payment to be made on 31st January 23, and it would be 5141.